All right, Bitcoin just did something pretty wild, blasting past $117,000. It's the kind of number that makes everyone, from the crypto curious to the seasoned pros, really lean in and ask, is there truly more gas in the tank?
Mm-hmm.
Or are we riding another peak towards a cliff?
Yeah.
Just like we've seen in so many cycles before.
It's the $1,000,000 question, isn't it? Or maybe the $100,000 question right now.
Ha! Exactly. Well, get ready, because the answer, according to two absolute titans in the market, is a resounding, confident, almost audacious yes.
Okay, I'm listening.
We're talking about Jeff Park, the head of Alpha Strategies at Bitwise, and Nakachi, managing director at XBTO. Now, these aren't just casual observers looking at charts.
No, not at all. These are deeply, deeply entrenched players.
Right, and their prediction. Bitcoin could astonishingly reach $200,000 by year's end.
Wow. Okay, that's a bold call, even for Bitcoin.
It's a huge claim. But here's the kicker, and this is where it gets really fascinating. They believe this isn't going to be driven by the usual suspects. Forget the retail fear of missing out rallies we all remember.
Right, the FOMO wave.
Forget even the traditional institutional adoption we've seen to date, like the ETFs.
Yeah.
They're pointing to an unexpected, yet incredibly powerful new force. A wall of money poised to flow in from, well, corporate treasury departments.
Corporate treasuries. Okay, that is interesting. That's not the typical narrative.
Exactly.
Yeah.
So let's unpack this. Who are these market veterans, really? And what gives them this extraordinary level of confidence in such an ambitious target? $200 is, well, it's a long way from here.
It is. And what's truly fascinating here, as you hinted, is that their confidence isn't rooted in the usual market indicators or, the kind of speculative fervor we've observed in previous cycles. It points to something structurally, fundamentally different happening. So, Jeff Park, as you said, head of Alpha Strategies at Bitwise. For listeners who might not be familiar, Alpha Strategies isn't just about tracking the market. It means his team is constantly looking for ways to beat the market.
Right, finding that edge.
Exactly. They're identifying unique opportunities, often by spotting these sort of underappreciated shifts in capital flows or fundamental changes in how an asset is perceived. So his insights aren't just about trends, they're about understanding what's really driving significant capital movements.
Got it. Deeper than just chart patterns.
Much deeper. And then you have Nakachi at XBTO. As managing director, he's right at the forefront of institutional crypto finance. XBTO is a major liquidity provider, market maker, asset manager.
So they're in the trenches, basically.
Absolutely. Nakachi isn't just observing from afar. He's seeing direct, real-time institutional order flows. He's dealing with large block trades, talking to major corporate and institutional clients every single day. He's literally at the coalface where the big money moves in crypto.
Okay, so these aren't just guesses based on sentiment. They're seeing actual mechanics, actual flows.
Precisely. When they put out a prediction like $200,000, it's not just conjecture or, drawing lines on a chart. Their insights come from a much more fundamental observation about actual capital movements and this profound, accelerating shift in how Bitcoin is being perceived and, crucially, utilized within the corporate world at the highest levels.
Utilized. That's the key word there, isn't it? Not just speculated on.
Exactly. They're witnessing a paradigm shift that goes way beyond just allocating a small percentage of a traditional portfolio to a new asset class. It's about how companies themselves are actively starting to rethink their balance sheets, their core financial strategy, and the long-term strategic role Bitcoin might play within that.
So it's not just a new type of investor dipping their toe in.
No, it's potentially a whole new category of corporate capital making its debut. And that, fundamentally, is a remarkably significant distinction. It signifies a real reevaluation of digital assets happening right at the heart of corporate finance.
And that takes us directly to the core of their argument. Because, this isn't about your average Joe buying a little Bitcoin on Coinbase, or even a hedge fund making a quick tactical trade.
Right. Different ball game entirely.
They're talking about something far more profound, something that can fundamentally change Bitcoin's market structure. And here's where it gets really interesting. We're talking about a completely different, traditionally very conservative player stepping onto the field. Corporate treasury departments.
Yeah, the folks usually focused on stability, liquidity.
Yeah.
Not exactly crypto pioneers, typically.
Exactly. These are the people tasked with safeguarding a company's cash, managing risk, ensuring financial stability, not usually venturing into volatile new asset classes.
So just how significant is this corporate interest, really? I mean, it sounds like a huge claim, but what's the actual scale we're potentially talking about here? Is it quantifiable?
Well, According to Jeff Park, yes. And the scale is, frankly, staggering. This is where he dropped a truly eye-opening figure during that coinage panel discussion you might have seen.
Okay, what was it? He revealed that there's currently over $15 billion in corporate Bitcoin treasury purchases lined up.
15 billion with a B.
15 billion with a B. Let that sink in for a moment.
Okay. That's a substantial number on its own.
It is. But to truly grasp its immense potential, you need to put it into context. Think about the first half of 2024. Remember all the hype around the Bitcoin ETFs?
Oh yeah, massive inflows dominated the news cycle for months. Huge deal for institutional adoption.
Exactly. They brought in hundreds of millions, billions eventually, widely celebrated as this monumental institutional catalyst, right?
Yeah.
But this $15 billion figure that Park is citing, it absolutely dwarfs those ETF inflows.
Dwarfs them. Really.
Completely dwarfs them. We're not just talking about being a bit larger. It's a difference in magnitude that suggests a whole different animal is potentially entering the market here.
Wow. Okay. So just to be clear, the figure for planned corporate treasury buying makes the actual, realized, hugely successful ETF inflows, which we all thought were the main event for institutional money, this cycle look relatively small in comparison.
That's essentially what the comparison implies, yes.
That's not just a major shift. That's a complete recalibration of what we thought was even possible for Bitcoin demand in this cycle.
Precisely. If you connect this to the bigger picture, the sheer scale of $15 billion, especially when you set it against those ETF flows, it suggests a truly momentous shift in capital allocation. It signals a deeper, more systemic integration of Bitcoin into, well, what we traditionally consider mainstream finance.
So more than just an investment product.
Much more. Think about what the ETFs represented. They were a fantastic development, make no mistake. They provided a new, regulated, and pretty easy on-ramp for traditional institutional money. Wealth managers, family offices, maybe some early adopting pension funds to get exposure to Bitcoin without dealing with direct custody.
Right. Made it accessible.
Exactly. It was a game changer for market legitimization and definitely boosted liquidity. But what Park and Nakachi are pointing to now is fundamentally different.
How so?
It's not just about institutions getting exposure through a financial product like an ETF. It's about corporations themselves actively choosing to hold Bitcoin directly on their balance sheets.
Ah, okay. That feels different.
It implies a far more direct, and you could argue, a much more committed form of adoption. When a company decides to put Bitcoin into its treasury, it's not like buying shares in an ETF that you might trade out of next quarter if sentiment shifts.
Right. It's a bigger internal decision.
It's a deliberate, strategic decision about the company's core financial assets. This isn't just speculative trading or a tactical allocation looking for a quick pop. It feels more like a profound reevaluation of what constitutes a prudent, long-term treasury management strategy, especially in this rapidly evolving global economic landscape we're in.
So the money is stickier, maybe.
That's a great way to put it. Capital from corporate treasuries tends to be far stickier and more foundational to a company's financial health than, say, short-term investment capital from a fund. It represents potentially a new, deep layer of demand that could really reshape Bitcoin's market structure going forward.
So it's not just another source of demand.
It's a fundamentally different type of demand. It signals a real maturation of the asset in the eyes of some very serious, traditionally conservative players.
And when you think about $15 billion coming into an asset like Bitcoin, I mean, the supply is famously limited.
Exactly. Bitcoin's entire liquid supply, the amount that's actually available for active trading on exchanges, is already pretty constrained. If $15 billion of new capital is specifically targeting Bitcoin for treasury purchases, meaning it might not come back to the market soon, if ever, that represents a significant potential absorption of the available supply relative to current liquidity. Imagine if, I don't know, a major commodity market, say copper, suddenly saw a huge new industrial player emerge, committing to buy and then permanently hold a substantial chunk of its annual production off the market.
The price would go nuts.
The ripple effect would be immense, right? For Bitcoin, which has an even more limited and predictable supply schedule thanks to the halvings, this isn't just a new flow of money, it's a potential structural shift that could tighten the market in ways we haven't quite seen before, at least not from this particular source and with this kind of long-term intent.
Right. And that intent, that long-term view, seems absolutely critical here. It leads us directly to what makes this corporate interest not just significant in scale, but fundamentally different from anything we've witnessed in previous Bitcoin cycles. Jeff Park made this crucial assertion that honestly sounds almost counterintuitive at first for Bitcoin.
What was that?
He plainly stated that, for the most part, these are never going to sell Bitcoin.
Never going to sell. That's a strong statement.
It really is. So what does this mean for us trying to understand the market? We're definitely not talking about short-term speculation. It doesn't even sound like traditional long-term investing where you eventually look to take profits, maybe after hitting a certain target or time frame.
No, this suggests something else entirely.
Yeah, it implies these corporations are planning to hold this Bitcoin for a very, very long time, like potentially indefinitely.
That is indeed the critical distinction, and it's what truly sets this potential wave of corporate adoption apart from maybe anything that's come before. When Park says never going to sell, he's articulating a concept that fundamentally redefines the nature of this demand.
How so?
These corporations, in this context, seem to be treating Bitcoin not as a volatile speculative asset to be actively traded for profit.
Which is how many still view it.
Right, but rather as a strategic reserve asset. Think about how companies normally manage their treasuries. They hold cash for immediate needs, short-term government bonds for stability, and maybe a tiny yield.
The safe stuff?
Exactly, maybe some longer-term debt or equities for growth. But all of those traditional assets are generally managed with an eye towards eventual use liquidation, reinvestment, funding operations. There's an expectation they'll be converted back to cash at some point.
Okay.
But with Bitcoin, if Park's characterization is right, the underlying philosophy seems to shift dramatically. It sounds more akin to how some companies might hold, say, critical real estate holdings, or maybe essential intellectual property, assets that are core to their long-term strategy.
Means they don't intend to flip quickly.
Precisely. The primary intention isn't to sell for a quick profit, but to possess it for its fundamental, enduring value and its strategic utility. For Bitcoin, this value could be perceived in multiple ways, couldn't it?
Like what? Inflation hedge?
That's a big one, certainly. A potential hedge against inflation, especially given the current global macro climate. Unprecedented money printing, soaring national debts, the potential for currency devaluations down the line. Holding Bitcoin, with its hard-coded scarcity, could be seen as a way to preserve purchasing power over long stretches of time.
Makes sense. What else?
Well, it could also be viewed as a strategic hedge against geopolitical instability, maybe offering an uncorrelated asset in an increasingly volatile world. Or perhaps, more simply, it's seen as an asset that's likely to appreciate significantly over decades because of that inherent scarcity and its growing adoption as maybe a foundational layer in the digital economy.
So it raises this really important question.
What?
What is this long-term strategic value that these corporations are seeing? Why would they essentially lock up billions in capital this way, treating it almost like a permanent holding rather than a liquid asset to be traded?
It implies a profound belief, doesn't it? A belief in Bitcoin's ability to not just maintain, but substantially grow purchasing power over very long periods. Perhaps even outperform traditional safe haven assets like gold or certainly fiat currencies in the long run.
So it's a deep conviction play.
It seems like it. They appear to be making a calculated decision that holding Bitcoin is actually more beneficial for their long-term financial health and capital preservation than holding an equivalent amount of traditional assets, even if it means giving up immediate liquidity for those specific Bitcoin holdings.
It's almost like a macroeconomic statement by these companies.
You could see it that way, a strong conviction in Bitcoin's foundational, maybe enduring role in the future financial system. It goes well beyond just a simple investment allocation.
That's a truly powerful reframing, not just an investment, but integrated as a foundational piece of the corporate balance sheet, a strategic pillar. And Park really drove this home, didn't he? He described these companies as permanent capital holding vehicles.
Yeah, that phrase really stuck out, permanent capital holding vehicles.
It signifies this fundamental, almost seismic shift in demand dynamics. Because previous Bitcoin bull runs, as we know, were often driven by retail speculation FOMO, quick flips, or maybe institutional curiosity leading to tactical trades. Maybe 3 to 6 month positions they could easily liquidate.
Right, more opportunistic plays.
But this new wave, according to Park, is defined by entities making what he explicitly calls decade-long commitments, not tactical 3-month trades. It's just a completely different mindset, almost a philosophical shift in how they view this asset.
Indeed. Permanent capital holding vehicles is probably one of the most insightful ways to describe this potential phenomenon. It shifts the whole conversation beyond just the size of the investment, which is already huge, to the fundamental intent behind it.
Right. The why.
Exactly. When we talk about decade-long commitments, we're talking about a level of conviction that goes far beyond typical investment horizons, even for dedicated long-term funds. For a corporation to think in those terms about Bitcoin.
Wow. So what might that look like in practice for a company? A decade-long commitment to Bitcoin.
Well, imagine a company deciding to allocate, say, a portion of its retained earnings or its core treasury reserves to Bitcoin. Their primary motivation isn't, let's sell this in 3 months if the price goes up 20%.
No quick flip.
No. Instead, they might see it as a generational hedge against future currency devaluation, ensuring a core part of their capital base holds its purchasing power over many, many years, maybe somewhat insulated from central bank policies or geopolitical pressures affecting fiat currencies.
Okay, that's one angle. Any others?
Sure. Think about a global tech company, maybe one that foresees a future where digital assets and blockchain play a much bigger role in their business, supply chains, customer payments, whatever. Holding Bitcoin could be seen as a strategic preparation for that future.
Like getting ready for the rails of the future.
Kind of. It might allow them to participate more directly in the digital economy, maybe facilitate international transactions more efficiently down the line, or even leverage that Bitcoin as collateral for future projects without the usual friction of converting back and forth from fiat.
I see. So utility beyond just store of value.
Potentially, yes. But the key takeaway seems to be that the primary motivation isn't selling for immediate fiat profit. It's about preserving long-term value, enabling future strategic options, and maybe aligning their treasury with what they see as a burgeoning digital future.
That implies some serious internal discussions must be happening. Reevaluating risk, long-term strategy.
Absolutely. A very high degree of confidence in Bitcoin's long-term stability and utility as a foundational asset would be required. It's clearly not just a speculative punt in this scenario. It feels like a profound strategic pivot
Elevating Bitcoin from just an investment.
to a core treasury asset. Similar, perhaps, to how gold or major real estate holdings are viewed for their enduring value, not their quarterly trading performance. It suggests these corporations aren't just looking at Bitcoin's past volatility, but its future potential as maybe a global, neutral, censorship-resistant value network.
Okay, so we have this potentially massive amount of capital, $15 billion plus, lined up. And it's committed to holding Bitcoin long-term, effectively removing it from the liquid supply pool.
Yeah.
Huge implications. But when? When is this wall of money actually going to hit the market? Because, as we always say, timing is everything, especially if we're talking about 200 call it K predictions.
The timing is crucial.
And Park and Nakachi weren't vague about this. They specified a critical timing factor. They said many of these treasury deals are expected to come online in Q3 2025.
Q3 2025. Okay, that's specific.
Very. And there's a crucial prerequisite, a condition for this to happen, once U.S. Securities and Exchange Commission SEC approvals are finalized. So there's a very specific, almost date-stamped trigger event potentially in play here.
Yeah.
How absolutely crucial is this regulatory piece to the whole puzzle?
Oh, it isn't just crucial. It is the absolute linchpin. It's the critical unlock. Without it, this kind of large-scale, risk-averse corporate capital probably stays on the sidelines.
Why is this so essential?
Well, for large corporations, especially publicly traded ones, or those in highly regulated sectors like finance or insurance, the SEC stance provides the necessary legal clarity, the accounting clarity, and, frankly, the indispensable stamp of legitimacy.
Right, they need cover.
They need cover, exactly. Without clear SEC approvals or guidance, these companies face huge internal hurdles. Compliance, financial reporting nightmares, enterprise-level risk management, they need certainty. How do you even account for Bitcoin on the balance sheet according to GAAP or IFRS?
Good question. Is it an intangible asset? Inventory.
Exactly. Is it subject to impairment rules? How you classify it totally changes the look of their financial statements. And then there's custody. How do they hold it securely and compliantly, meeting standards like Sarbanes-Oxley for internal controls?
Yeah, auditors would have a field day with uncertainty there.
Completely. What are the securities law implications? Anti-money laundering, tax. Without a clear blueprint from the regulators, especially the SEC, a CFO at a major public company is just not going to sign off on putting billions into an asset where the rules are murky.
So the SEC approval isn't just a rubber stamp.
Not at all. Whether it takes the form of specific accounting guidance, maybe a safe harbor rule for corporate treasury holdings, or even new regulatory frameworks for digital assets, that SEC signal basically says, okay, Bitcoin is legitimate, it's manageable within existing financial frameworks, and it carries an acceptable level of regulatory risk.
It de-risks it for the big players.
It fundamentally de-risks it for a much wider array of corporate players who were previously maybe just too cautious because of the evolving, sometimes confusing regulatory picture. It builds the formal legal pathway for this wall of money to actually enter the system without companies fearing legal blowback or financial penalties. It's the infrastructure needed for this unprecedented leap.
Okay, so this regulatory green light isn't just a formality, it's the bridge. The bridge that lets traditionally conservative corporate finance departments walk confidently into the Bitcoin space. And when that bridge is fully built and open for traffic, which they're anticipating around Q3 2025, Bark and Nakachi predict something truly significant happens next. They say it could trigger a supply shock that sends Bitcoin's price soaring. Now, for listeners maybe less familiar, what exactly is a supply shock in Bitcoin's context? And why would this specific type of corporate buying cause such a potentially dramatic effect?
Okay, so a supply shock here refers to a sudden, dramatic, and likely sustained imbalance between the available supply of Bitcoin on the market, which is already shrinking, and a sudden surge in demand for it.
Okay, simple supply and demand, but amplified.
Exactly. And it's amplified because of Bitcoin's inherent design. We know its supply is mathematically fixed, right? Only 21 million coins ever. And new coins come into existence at a predetermined decreasing rate because of the halvings. The rate of new supply literally gets cut in half every 4 years or so.
Scarcity built in.
Scarcity is hard-coded. Now, introduce potentially $15 billion in new dedicated demand from corporate treasuries. And crucially, as we've discussed, these are potentially permanent holders with little or no intention to sell.
Right, they're not trading it.
They're not trading it, they're accumulating and holding. So you create this potentially unprecedented and very potent situation. Imagine again that shrinking inventory of a super desirable, scarce product, but suddenly demand for it just skyrockets from buyers who plan to hoard it.
Yeah, prices have to move.
This isn't just more money coming into the market, it's money that could effectively remove Bitcoin from the liquid tradable supply potentially for decades.
Yeah.
If these companies are taking Bitcoin off the open market permanently for their balance sheets, it just means fewer and fewer coins are available for everyone else.
Retail buyers, other institutions, even new companies coming in later.
Exactly. They're all competing for a dwindling pool of available coins. The existing supply of Bitcoin on exchanges, which, by the way, on-chain data shows is already at multi-year lows, could get rapidly depleted by this new, persistent, and fundamentally inelastic buying pressure.
Inelastic meaning they buy regardless of short-term price swings.
To a large extent, yes, if their goal is long-term strategic holding rather than short-term profit. So with fewer sellers and this explosion of dedicated long-term demand, the basic laws of economics dictate the price has to rise, potentially very sharply, to find a new equilibrium. Someone has to be enticed to sell.
It's not just more money flowing in, it's money that's actively locking up the supply.
Precisely. It exacerbates Bitcoin's inherent scarcity in a really profound way. It could create what economists sometimes call a demand-side liquidity crisis for the asset. Basically, the gap between buy orders and sell orders widens dramatically.
So prices could jump significantly just on relatively small volumes.
That's the potential outcome. Prices might have to move a lot just to convince anyone left holding coins on exchanges to actually sell them. This could lead to those really sharp, almost vertical price moves. The market sometimes sees those up-only phases, as people call them.
So this raises a pretty important question then. If a significant chunk of newly mined Bitcoin, or Bitcoin coming onto the market, is immediately hoovered up by corporate treasuries who never plan to sell, what does it actually do to the market's liquidity and its ability to discover price efficiently day to day?
It's a critical question. It could lead to periods of much higher volatility, paradoxically. Even relatively small buy-or-sell orders could have these outsized impacts on price simply because there isn't enough depth on the other side of the order book at current price levels. It suggests a future where Bitcoin might become increasingly illiquid on the open market precisely because it's being locked away in these long-term strategic corporate holdings. The scenario isn't just about the price going up, it's about a fundamental recalibration of Bitcoin's entire market structure.
Transforming it.
maybe transforming it from primarily a speculative trading asset into an increasingly foundational, perhaps somewhat illiquid reserve asset, a bit more like how central banks hold gold. It's there, but it's not really actively trading day to day in large volumes relative to the total stock. It would be a profound shift in its market identity.
That is a powerful picture. A market possibly poised for a really dramatic structural shift. Okay, so to bring it all together for you, our listener, what have we really unpacked today about Bitcoin's potential future and this potentially game-changing new force?
Quite a lot, I think.
First, we've gone beyond the usual market chatter, beyond just price predictions, to reveal this profound fundamental shift that might be underway. The quiet but potentially incredibly powerful rise of corporate treasury adoption. This isn't just institutional investment, it's moving Bitcoin potentially right into the core of corporate balance sheets. A new era, maybe?
A significant maturation, certainly.
Second, we've highlighted the sheer, frankly astonishing volume of capital that Park and Nakachi believe is waiting in the wings. Over $15 billion lined up. A figure that, as we explored, absolutely dwarfs even the very successful Bitcoin ETF inflows from earlier this year.
The scale is hard to ignore.
Third, and maybe this is the most crucial point, we've really dug into the permanent holder mentality of these corporations. They're not looking for a quick profit. They're acquiring Bitcoin, potentially, with the intent to hold it for decades, seeing it as a strategic reserve asset they are, quote, never going to sell.
Which fundamentally changes the supply-demand equation.
Completely. It's different from any previous cycle because it implies supply being actively removed from circulation long term. And finally, we've pinpointed that specific time-bound catalyst, the expected finalization of those U.S. SEC approvals potentially around Q3 2025.
The regulatory green light.
Exactly. That's seen as the indispensable key that unlocks this massive wall of money, which could then trigger that unprecedented supply shock, potentially sending Bitcoin's price soaring towards that $200 K target, or perhaps even beyond. This isn't just about a price call. It's about a fundamental reevaluation of a digital asset by very established, traditionally conservative corporations.
And that reevaluation, I think, speaks volumes about a broader, perhaps generational systemic change. It's not just a new investment trend popping up. It feels more like a potential redefinition of what constitutes a safe or strategic asset for a corporation in the 21st century.
Challenging old assumptions.
Directly challenging those long-held assumptions about traditional treasury management,
Right.
reliance on fiat cash, government bonds, conventional instruments. The very fact that serious corporate finance departments are even considering, let alone actively lining up billions for Bitcoin, signals a profound shift in economic philosophy and risk perception at a very deep level.
Okay, before we get to our final thought, just a quick note. If you found this deep dive valuable today, if it sparked some ideas, please consider supporting our work here. Subscribing to the deep dive, maybe leaving a comment with your thoughts, or hitting that like button. It genuinely helps us a lot.
It really does. It helps us reach more curious minds like yours and lets us keep digging into these topics and creating this kind of content. It tells the algorithms you're finding value here, which is great feedback for us too.
Absolutely. We appreciate you being part of the conversation.
So as you reflect on all this information, maybe consider this. What does this burgeoning, seemingly unprecedented corporate adoption of Bitcoin truly mean for the very definition of a strategic reserve asset in the global economy?
Good question.
Are we witnessing, maybe quietly but profoundly, the redefinition of what constitutes safe or prudent corporate treasury management? And if so, how might that ripple through traditional financial markets, the bond markets, foreign exchange, maybe even equity valuations in the years to come? Could it alter everything from how companies manage risk to how they view their fundamental long-term capital preservation strategies?
It's a question that definitely goes far beyond just the price of Bitcoin itself.
It really delves into the potential future architecture of global finance, something to think about.